Welcome to our Morning Tea and Learn workshop. My name is Paul Jantz. We're here thanks to Professional Partners Education and our wonderful friends and supporters at Hall Chadwick, Profit Master Global Outsourcing, iKeep and Lloyd's Auctions. So let me just double check to see how we're going here. Looks like we've got our guests coming on. So we've had to go a different way to get our guests online. So once they're online, they'll be showing up on the screen as well, which is fantastic. So back to this. If you're joining us for the first time, and I know there's a number of you that are joining us with team members in your boardrooms as well, so thank you for being a part of this. This is usually our lunch and learn, but unfortunately we do have actually a live lunch today, so we've had to make this a morning tea. There's a few of you actually online that are actually joining us for lunch as well later today at 12:30 p.m. If you're joining us for the first time, Professional Partners Education, let me just share a little bit about that. It was an educational platform built for all you guys, being our accounting community. So I do a lot of live masterclass shows where we do a lot of, call it non-technical, whether it be on leadership or marketing, business processing that we did last week. So we do a lot of different content. And then we've got these lunch and learns, which today's our morning tea, that we also record for you while it's live. There's a number of firms that can't make it. So it all goes onto our YouTube channel. So if you want to get into your Google browser, go into YouTube. If you type in Professional Partners Education, up will pop up PPE TV Plus, and all the content is there for you guys. It's free of charge. It's there for you guys to use. We just look at it from an educational point of view of what we can give back to our accounting community, which is fantastic. Have we got the guys?
We
just need your camera on, Roberto, if you've got you there.
Okay, that's okay.
And we can definitely hear you, which helps.
So it's saying that you're stopping our camera working.
Interesting. Okay, let me make you a co-host and let's see if that will help. There we go. We got it. Thanks, Roberto, to the rescue. And I've got Andrew Crawley there as well. So guys, let me just run through just quickly. I've gone through a little bit about Professional Partners Education. Now, our topic today, we're going to be talking about when is an ATO repayment plan appropriate. Now, over the last, I'll call it the last few weeks, Andrew Crawley and Roberto and I have all been talking about this particular, we'll call it it's a question, but it's also a statement. So when is the ATO, when is an ATO repayment plan appropriate? And I know Andrew and I have gone into a lot of detail about this. So before we kick off, because we've just got you guys online, let me introduce you to our two guests. We've got Andrew Crawley on the left, and we've got Roberto Crispino as well on the right, both from Hall Chadwick. Guys, I know certainly, Andrew, from your point of view, welcoming you back. You're on a few months ago, and I've welcomed you back to this session. For everybody that's online, can you maybe spend 60 seconds just giving everyone a little bit of a brief on what you do at Hall Chadwick and why you do it? Because you do play a very important role.
So firstly, to everybody, apologies. Anyway, our IT went down and we've lost it. So I've come into Roberto's office. But the good thing about that is you'll get both sides of the view. Roberto's a registered liquidator and a partner with Hall Chadwick. I'm a director with the group, but I'm neither of those things. I'm not a registered liquidator. I'm not even a lawyer. For 15 years, I ran an advisory firm out of Melbourne, and it was an advisory firm that we set up to protect directors, or look after directors that had some financial or statutory issues. About 5 years ago, I closed that down and brought it in to Hall Chadwick. And so my role is I work with the directors and between the director and the registered liquidator before they take the appointment, if you like, and just so that everything's cool so we can explain it and look at all the exposures.
Brilliant, brilliant. And I think that's the great thing, I think, with the firms within our community that you've worked with in the past. It's probably it's the angles that you tend to look at, and it's certainly no disrespect to any of the liquidators out there, and Roberto's part of our team. It's definitely no, but you've got a different way of looking at things, which is what I think the firms enjoy as well. And then, of course, you bring in someone like a Roberto when the time's right. That's probably fair to say.
Yeah, 100%. And often Roberto's, all of the partners, but often Roberto will let me work with the director if there's some community issues on the way through. And, that's not any technical advice, but there might just be matters of relationship management, documentation's needed, that type of thing. I think we're the only firm doing it, and I think we do it really well.
Yeah, I would agree with you. And I think the feedback is exactly that as well. So it's fantastic. Let's get into this because it is interesting. and we've been talking about this for a little while now, so we thought we'd share this in the broader sense. There's about $86 billion of ATO debt outstanding and ready to recover. We know that they're stepping up things. We've probably had 2 years of cover, let's call it, for most directors, but they seem to be coming pretty hard. So I know you and I have spoken about this a lot. Maybe let's chat about some of the ATO recovery strategies and activity of late. Is that something you can talk about, mate?
It is, and Roberto, correct me. I was going to talk freely, but now Roberto's here to correct me if I'm wrong, which puts a bit more pressure on. However, look, I'm one of the few people that, well, I shouldn't say the few. I actually think the ATO is doing a really good job. I think that they've handled this whole COVID and recovery COVID thing very admirably, perfectly frank. When they came out of COVID, we all know that they did nothing in COVID, which was appropriate. When they came out of COVID, I believe it was around March last year, not this year, they sent out some 70,000 DPN warnings. So effectively, my view on what they were saying, and Roberto will correct me if I'm wrong, my view on what they were saying is, hey, look, we understand what's happening in COVID, but you're the director of the company. It's your job to look after it. You need to deal with this now. Otherwise, we're gonna deal with it, right? So they sent those out and they didn't do anything for a few months. So they let everybody, gave everyone time to deal with it and digest it. Then I think, Roberto, I think it was around about July, August last year, we started to see a pickup in wind-up activity. Yeah. So what I'm referring to there, Paul, is when the ATO winds a company up, there's a process. They'll send them a stat demand, but then they make the application in court to wind up the company. And that's got back up to the stage now where we've seen between 20 and 30 of those a week, and that's the equivalent of pre-COVID. So a lot of people run around saying, oh, the ATO is really, really savage, but they're not. They just returned to normal. It's not that they're savage now, so they weren't savage over that period, but the activity's out there. Now, the thing that I can't tell you is how many DPNs are going out, direct penalty notices. I understand there's a new form of direct penalty notice that I haven't seen yet, something called a lockdown, which is a normal direct penalty notice will give you 21 days to liquidate the company. A lockdown notice, when it appears on your desk, it's over. You're personally liable for it. Now, I can only envisage that that's a reaction to that warning that they sent out a while back. So we've given you a warning, we've given you the time, another 21 days ain't going to help. So they seem to be aggressive, but they're not. They're just back to their normal standard. They're just doing their job.
Yeah. Well, I suppose when you've got that level of money to recover as well, that's outstanding, you can understand where people have had that, call it that 2 years. You're right. The DPN's gone out. What's next? So interesting, this lockdown, which is interesting, and I'm sure that'll cause a bit of chat around the table this afternoon as well at our lunch. Now, repayment plans. Again, this is something that, again, you and I spoke about when we were away a few weeks ago over in Queensland, and we started talking about ATO repayment plans, payment arrangements. The staggering stats that we were talking about was 8 out of 10 failed. So it's interesting. So one of the reasons why we've asked you back today is exactly about that. You're very passionate when it comes to distressed directors entering into ATO repayment plans when it may not be in their best interest to do so. Yeah. We've got a lot of different tax advisors on this morning tea today. So maybe tell us what your thoughts are on these types of arrangements, and what would you mind sharing with the views on all of this?
Well, firstly, if Roberto disappears from the screen, he's fainted. So I apologise for that. Look, my view on this, when I was running the advisory firm, and I keep the same view now, I think the ATO payment arrangements are a magnificent thing for a solvent company. If you let the tax get behind, the ATO repayment arrangements is a wonderful way to catch up and just get your business moving. But the reality of it is the vast majority of companies applying for them are insolvent. So if I can just explain it to you with basic stuff. So say there's a small company with a $350,000 tax bill, and I mean the tax advisors on this seminar will be smart enough to be able to go and get that tax, all the penalties and fines remitted. So say it brings it down to 240, and I only say that because my math's not great. It's going to sound easier for me. Yeah. So they bring him down to $240,000. Now, what they've got to remember is whilst this company got into trouble, it was already paying the unsecured creditors with the exception of the tax, and there was no money left over. And so all of a sudden, what you're doing is you're introducing into this insolvent company an additional, just say that you could get it over 2 years and $10,000 a month. You're introducing an additional $10,000 a month payment on a company that couldn't pay it beforehand, right? It's crazy, but it gets worse than that. As you all know, once you do that, you've then got to pay your BAS on time. So let's say that style of company probably has something like a $40,000 quarterly BAS. So it's monthly, it's 10,000, 10,000, 50,000, 10,000, 10,000, 50,000. It's not possible. Okay. I know it's easy to put on a spreadsheet. I know all the advisors out there, you're working with your directors. And I understand, I've done it myself, when you put all these wonderful things into a spreadsheet to show what's going to happen to the company. But the reality of it is, if you're dealing with what's going on in the company, they can't possibly afford to repay it. And that's the reason that they're failing. It's not because the repayment arrangements don't work. It's because they've gone too far. And there are better options now. And the ATO, well, in my opinion, and again, I'm seeing the ATO is supporting other options as well.
So let's talk about that, because I think it's interesting. Sort of one of the things that we've often spoken about is what's in the best interest of the client. And you're right, at the start, the ability to take a deep breath and go, oh, okay, now I can relax. I don't have to come up with that $240,000, as you mentioned. Yeah, we've had the penalties and we've had the interest taken off, and great, but you're still left with the debt. But as you said, and some are in weekly arrangements as well, not just monthly arrangements. So what are you suggesting which could be in the better interest of some of the directors?
Well, a restructure, and by the way of either a small business restructure or a voluntary administration, it's a totally different insolvency market now post-COVID than it was pre-COVID. I mean, without giving too much of a plug to Hall Chadwick, pre-COVID, you would see 8 out of 10 companies that went into a voluntary administration that would be followed up with a liquidation. Here at Hall Chadwick, and maybe a little bit out in the industry as well, we're seeing it the other way around now post-COVID. So we'll get involved and we will trade a company, we will bring it out. The small business restructure is a great way as well. Now, the other thing you've got to think about this is, with these restructures, they don't just deal with the tax, they deal with all of the unsecured creditors. Now, I understand that you can, with the ATO repayment arrangement, you can remit the tax possibly. I'm not saying that there's any agreement to do that, but I suspect the quality of these advisors, they'll be able to do that. But you're only going to get, that's only going to be like 30% off. Now, these structured repayment arrangements, provided they can be supported by the administrator and presented in that manner, you can get 20 cents in the dollar across all of your creditors. And when you're doing that, the other thing is, the thing about these administrators, this is what I love about the voluntary administration process. You're actually getting a forensic audit on your own business. So these guys go in and they do, and they're good at it. Trust me. They're going to come out, you're going to understand all the financial aspects of your business that you might not have looked at before. They're going to tell you whether you can sustain a payment plan. And if you all agree to a payment plan, then they're going to put it forward and they're going to recommend it. And these guys are, they're all officers of the court. These are the gatekeepers, right? They are listened to. And you can clean up your business. You can do anything you like in these restructures. And it's a better chance of it coming out of it. And the reason that I say this is because, I don't want to repeat myself what I said about the tax arrangements, but the reality of it is, if an insolvent business is going into a tax arrangement, I know that may technically make it solvent because there's an agreement to repay the tax, but it doesn't mean it can repay it. And the other problem is that if it goes down, and if it gets to that 6 months where you've gone 10, 10, 50, 10, 10, 50, there's no money left to restructure. It's not there. Everything's been sapped out to try and keep the thing alive. So that's why I believe it's a much better, well, I believe tax advisors should be considering. Can I say something about something you said earlier? And that was, when you go into the payment arrangement, it's a great relief to the director because he had this and it's gone. And that's very, very true. And it's the opposite in a restructure, because in a restructure, all the stress is pushed on that director at that point in time. It's entirely the opposite, but it's also the opposite coming out. So when you, with the ATO payment arrangement, as you're going further and further and further into it, the stress is building up further and further and further. The company's getting worse and worse in trouble. With the restructure, it's completely the opposite. So yeah, you get belted first up. The director, it's a hard sell. I'm not going to kid you, but let us do that for you. Right? And we can get the director over the line. He gets all the hard work up front, and then it gets easier and easier and easier as he gets his business back. It's completely the reverse. So the advisor keeps the business. It's for mine, it's a no-brainer.
Paul, can I just support what Andrew's been saying and touching before what's best for the client, and that payment arrangements another reason why it might not be the best option for an insolvent company is if the company is entering into these payment arrangements, but ultimately does default and goes into liquidation. Those payments made to the ATO will then come under attack by a liquidator in terms of preference payments. And the ATO then has the ability to join the director to recover those payments. So the client is actually then at risk. Whereas if the company is insolvent, the small business restructure is just the better alternative, because you can then recover, you can then settle the ATO debts as well as the unsecured debts. And you're going to absolve yourself from those preference issues.
So the best, people say to me, how do you protect the director? Well, the answer is quite simple. What you do is you don't go into liquidation. So the best way to protect the director from his personal guarantees, from his liabilities, is for the business to trade. There's no question. There's no lawyer in the country that can do as good a job of protecting a director as the director can do for himself by continuing with the business.
Now, you mentioned before that, and I think your words were ATO friendly. Is that what you meant by the business restructure or the small business restructure? Because that was something that the ATO sees quite friendly. No.
So what I was saying is that what we're seeing, and Roberto might be better at this one. What we're seeing is where there's, and again, the plan's got to be it's got to be worked with the director, and the plan's got to be put forward by somebody that's accepted. And if the ATO can see that it's going to work, they will often vote for it and vote for a significant reduction. All right. So they're not running around. I can't speak for the ATO, obviously, right? But what I'm seeing is the ATO, and this is what I said to you earlier, I reckon they're doing a great job. I think the ATO genuinely wants businesses to continue, but conversely, they genuinely want directors, when they're not going to continue, to tidy up their own mess. You know, so the ATO, I've seen them be quite supportive in these deals.
Yeah, good. And that's what I meant by the option of being friendly, because at the end of the day, this was
that's a bit over the top, mate. Friendly. They are doing a great job.
But to be fair, the small business restructure was brought out by the government to actually help businesses.
Yeah, and keep employment. Nobody wants people out of work.
No, yeah, that's right. So just quickly, just for the firms that are online that may not know much more about, can you just share a little bit about how the small business restructure, there are 2 or 3 key things? I know there's certain debt levels it needs to be under. Can you share a little bit about that?
Do you want to pick this one up, Roberto? I'm happy to do it, but I tend to make stuff up.
I suppose the easiest way to describe it is the small business restructure, or SBR. It's the VA light. So it's a much cheaper and friendlier option of a version of the VA for small businesses. And the one key for the SBR in terms of, it's a much lower cost to directors, but under the SBR, the control of the company stays with the director during the course of this process, rather than a VA where it reverts to the administrator. That's where a lot of the cost is. In terms of eligibility for an SBR, the company must have debts of under $1 million. The employee entitlements must be paid, and all employee entitlements that are due, and the tax lodgements must be up to date. So that's the eligibility. And obviously the company is precluded if they previously undertaken an SBR in the last 7 years, which is unlikely at this stage. So those are the key eligibility requirements. Under the SBR, from the date of appointment, the director has 20 business days to put forward a proposal to their creditors in terms of compromising all debts moving forward. Creditors then have 15 business days to vote on that proposal, and a simple majority in value and number is what is required. Any proposal from the director can last a maximum of 3 years. I think the ones
so you mean repayment, so
the repayment period of that proposal.
Yep.
I think what we've seen so far is most proposals are going at that 12-18 month mark. And most creditors are tending to accept anywhere between a 10 to 15 cents in the dollar return for their debts, which, when you compare that to what a payment arrangement to the ATO might look like, is probably a more friendlier and better option.
And that covers all creditors, not just the tax office.
That's right.
I don't know, Roberto, I've also seen things like with the small business restructure, the authorities and the creditors don't seem to be considered to be such a savage issue on the director. And in that regard, we've done a couple recently that with the building sector, we understand everything that's going on. So with the building sector, licenses are in danger the second you have any act of insolvency. And what we're seeing is that with the SBR, even the building license people are sort of viewing it in a different way. It's like, oh, okay, if it's an SBR, you might be able to come out of it now. Because it's only for small business, that doesn't include the larger builders and whatnot, but the little guys. So it's easier on the director when he comes out of it. You know, it's not like they're saying, oh, you've been through a liquidation, what happened? They're not saying that. They're saying, oh, you've been through a small business restructure, the company's fine. Yeah.
Yep. So what you guys are seeing in the marketplace, this could be a better alternative to a repayment arrangement. Is that what you're suggesting?
From my view, and I'd like to hear Roberto's view on that, but from my view, the repayment arrangement is the one you want to go for, provided the company's solvent.
Solvent, yeah.
Right? The problem is by the time they get to that stage, they're not solvent. And nobody knows that better than the other people in this seminar. They're just not. I mean, we all know, we see it when we all want to help a director, you know, when it's in front of you, especially when they got, you know, but at the end of the day, they're not going to be able to make the payments. There's no way you can, I mean, you can put whatever you want on a spreadsheet. It's not going to make a scrap of difference. I think it was Winston Churchill. He said there are 3 levels of dishonesty in this world: lies, damn lies, and statistics. So you can put anything you want on a sheet of paper, but it's not going to pay those bills, and it's not going to feed the director's family.
Paul, I think, as Andrew said, for insolvent companies, I think the SBR regime is a much better alternative than direct payment arrangements with the tax office. I think at this stage, or over the last 18 months, it's been quite underutilized as a piece of legislation or restructuring technique, mainly because it is quite new. It only came into effect about 2 years ago, and there might not be enough knowledge about the regime out there in the market. In some instances, the $1 million threshold can be quite limiting to some businesses, but it's definitely if eligible for these insolvent companies, I think it's the much better alternative than an ATO payment arrangement.
Yeah, well said, well said. Now, you both mentioned earlier as well, you both spoke about the voluntary administration, a small business restructure as an alternative to a tax repayment arrangement as well. But are these options even available to the average business once they get to that stage?
Yeah, they are. Well, again, I'm going to get Roberto to comment because he knows, but for mine, they're not only available, they're more available than they've ever been. The small business restructure was never available. Look, don't get me wrong. If you start going in and you've got a perfectly healthy company and you're looking to do them, well, it's not going to happen, right? So the company's got to be in trouble. And if the company is in trouble with this new level of SBR, it's brought the voluntary administration really only worked in the old days. If you don't mind me saying that, that's pre-COVID. For the larger style company that had an objective, it's not the case anymore. Even small voluntary administrations were getting through and trading out of them, but the SBR, it's available they're available to anyone as long as the company. All Roberto would probably want to see, and again, I'm going to ask you to comment on it, mate. All Roberto would probably want to see is that there's a path forward, and that when he does his analogy, his financial examination, that it can be supported by the numbers, and then it's available. And am I close to the mark? Or?
Yeah, so the proposal that gets put forward to creditors, as the small business restructuring practitioner, my report to creditors will be outlining the estimated return through the restructuring proposal compared to a liquidation scenario. And as long as the proposal it stacks up, it's what we will recommend.
Okay, great. So I know Hall Chadwick, both you guys are a part of it. We're a large national firm with many administrators. Our PPE community of accountants and tax advisors here, if they wanted to start that conversation about a particular client, sort of what are the options that may be available to them?
I'm going to take this one if you don't mind.
Yep.
Ring me.
Okay.
I mean, ring me personally. We're going to send you an email after this. I've got a group of BDMs that work under in the area, but you ring me, right? Always have the first conversation with me. I like that to occur because we can talk together and establish with the director right? If the advisor wants us to, right, we can meet at their offices. I'm national. I'm traveling all the way. I was Brisbane yesterday, Sydney the day before. Happy to meet. We can just talk through with the director. He can tell the story. I can relate back some likely scenarios. Most importantly, the type of exposures he may face. He can move forward with a certain option. And with the accountant there as well, it's the best way to do it. And you know, we just agree if there's a way to go forward. So the answer to your question is, mate, ring me, please.
Okay. Brilliant. Is there key information that before they ring you that they should have to have that conversation with you?
No. So especially where the accountants are ringing, they know it anyway. Right?
Okay.
They know it anyway. They know more about the finances of the company than the director in most cases. It's not how it's supposed to work, but it is. And they'll already the young issue. The issue I just want to get across to an accountant is, you're 100% correct. In the old days, liquidators existed to end the company, so they should be your last port of call. It's completely, and especially at Hall Chadwick, where we push towards trade-ons, it's completely the opposite now. Literally, when you're looking at if you're looking at a tax repayment plan, and an accountant will know it, he turns around and goes, "Oh, well, this guy's getting through this." That's when you should call us.
Okay. Now I've just gone to my phone quickly. You okay for me to share your number on this chat?
Yeah, anything you like, yeah.
Do anything you like. I'll stop there. So guys,
And I do actually have my own office, just so you know. It's just next door. I just like to.
So I've just shared Andrew's number. So this is the great thing about what these are about. And you're right, there probably hasn't been as much discussion over the small business restructure. I know even at our last Melbourne lunch, probably 6 weeks ago, there was a lot of chatter when we went downstairs for a drink afterwards. And a lot of people were talking, oh yeah, look, that could be better. Yeah, look, I need to know if I need to find out this. There was a lot of great chatter about that. And I think this is what the starting point is. And Andrew's saying, if you do have clients that are in that situation, there's his phone number. I've just shared it. Write it down, call it, text it, do whatever you want to do. And then you can actually start. Because I think that is going to be really, really important. Before I just go to Roberto for just a quick comment, if you've got any questions, I know there's a couple that are starting to filter through into the Q&A. If you've got any questions you want to throw into Andrew or to Roberto, please throw them into the Q&A. We're going to get to them very, very soon. Sorry, Roberto, was there something you were going to add to that, mate?
I just wanted to say with the SBRs, the rates in which they're getting approved by creditors is actually quite high. So I think the last round of statistics that were published through ASIC was the success rate was 75-80% plus.
Wow.
So they are a vehicle that's getting supported quite largely by the ATO. That they are the major creditor, or they are a creditor in 90% of the SBRs, and the major creditor in around about that number as well. Now, if in the unlikely event or infrequent event that the SBR does not get approved by creditors, that doesn't preclude the director from any other insolvency or restructuring option after that. So they can still put the company into VA if they'd like. They can still put it into liquidation if they'd like. And it doesn't speed up any other process from a statutory demand or creditor process. So it is, with that in mind, it is a good piece of legislation, almost a free hit to compromise your broader debts if you do meet the eligibility criteria.
Yeah, and I like the wording of it as well, because it's a small business restructure. If they can fall under the $1 million of debt, it's a restructure as opposed to a VA, which has a different connotation to it, which people get a little bit afraid of, don't they?
And they're retaining control of the business throughout, which is another leg up as well.
And Roberto, the biggest hurdle I'm seeing is when Roberto mentioned earlier about the unemployment benefits, the employment entitlements that were due, that's invariably superannuation. So what you find is that's one of the biggest hurdles. If you're into the ATO for 350, you're going to have a few employees. There's probably going to be 30 or 40 grants worth of super there, and that's got to be paid before Roberto's team can submit the plan. So that's what I'm seeing as the biggest hurdle for directors. We're finding ways around it, not around paying it. We're finding ways to get it paid and get it done.
Yes.
But that's what I see as the biggest hurdle. But you've got a nice clean company when it's all over and all your employees are happy.
Yeah, very true. So the question is, how would the SBR address the ATO debt?
It's included. So the
total creditors.
Yeah. So, and again, he's going to jump in and fix and correct me because he's the guy I go to ask questions about this. But it's just included. So all the unsecured debt goes in there. If there's $100,000 worth of trade suppliers or whatever it might be, and $200,000 worth of ATO, it's put in, and that's a $300,000 debt. Roberto's team will put a plan together to repay the whole debt, and it all gets paid out. If it's agreed on 15 cents on the dollar, it's 15 cents on the dollar across the whole board.
Yeah, that's right. It's included with all the unsecured debts, and I think one of the reasons why the ATO has been supportive of this legislation and these proposals is because the eligibility includes you having your lodgements up to date. It's getting the taxpayer re-engaged with the system, and it's also keeping businesses trading and saving jobs. So that's why they've been supportive to date.
Yeah, brilliant. Thank you. Hopefully that answered all the question. Well, there was a question there from Prasanth. So hopefully that answered that, mate, because it's all inclusive as long as you make those. I think it was debts under $1 million, employment like your super up to date, and your BAS is lodged. So they're the three key ones that under an SBR. Any other questions to come through? Beautiful. Thank you. Always good to get a thumbs up there, which is awesome. So if you've got any other questions, please, or I sort of just put in Andrew's number. You got nothing to lose by giving him a call and having a chat. I think that's the great thing about what we're doing here to help all of you with your clients that are in these situations. And I deal with a lot of accounting firms every single day of the week. So I know how many repayment plans are in place, and I know how hard I've been involved with businesses as well that have had trouble actually paying the repayment plans, because you're right. Unfortunately, they go into the repayment plan and they're not solvent, which causes a problem right up front. So chat to these guys. You got nothing to lose, everything to gain. And I suppose sort of one of the great things that I know that Andrew and I have spoken about as well, and Roberto at our lunches, has been we're here to help you save your clients' businesses. And I think that's the great thing about what Hall Chadwick does. And we're always looking at proactive solutions. It's not, if it's too late, it's too late. And Andrew mentioned that right at the front. So you've got the ability to take some proactive steps here to find out more information, have a chat. Can't hurt having a chat, costs you nothing.
Paul, can I just say also, we're very, Hall Chadwick, we're very supportive of what you're doing, this whole network. So I don't mind if an accountant were to ring me and say, hey, Andrew, I'm part of the network. It's got nothing to do with an insolvency really, or his client. My client's just got a preference claim from another liquidator from one of his payments, I can talk them through that, right? I'm happy to do anything at all. We'll support.
Brilliant.
Only because insolvency is a funny area, right? It's just a funny area.
Yeah, and I think people, it's sort of one of those things that, again, it's great being a part of this with you guys, because the more information you have, the more or the better decisions that you can actually make. And I think directors, and I've got friends that are in similar situations where they think they can hide, or they think they can bury their head in the sand, and they think that it's going to go away. But you know what? It's not. The sooner you engage, the sooner you start talking about it, the sooner you come up with proactive solutions, that's what's going to help the director at the end of the day. And I know, like we've said before, usually there's two directors. One of them's a wife. The wife is probably about to lose their family home. She doesn't know that. And that's where shit's going to hit the fan. And that's what the proactive conversation can take before it gets to that. And that's what we're all about at PPE, and of course at Hall Chadwick, which is brilliant. Any other questions apart from those little technical difficulties it looks like we've got there, which is fantastic?
Yes. If anyone out there does IT, we're going to be in the market this afternoon.
We got a gig for you.
A firm's about to lose a large contract, just so you know.
Well, guys, thank you again for your time. These little sessions are only 35 to 40 minutes, so thanks for joining us. Great little session again. This is all about education. So if we can help, if you've got clients that are in that situation, I had firms. I was on a chat with a CPA group out of Sydney only 2 weeks ago, and the question came up: where do we start? Again, you guys as tax practitioners will know. You'll know who has got tax debt. You'll know who's in a repayment plan. You know who could have defaulted. All these things. So there's your starting point. It's not a scattergun approach. It's, if anything, a very targeted approach to start talking to clients about, again, have that conversation. It's a fantastic conversation to have. It's a care conversation, and then reach out and chat to Andrew about it as well. And you've got the ability to pull in all different layers of information to help your client, help them to survive. And that's what we're all about. So any final little comments, Andrew, Roberto?
Here if needed, mate.
Yeah, well said.
Just the comment is, I suppose the insolvency landscape has changed quite a bit in the last 5 to 10 years. And it has to be a mindset shift that what we do now is not just liquidation. There are many different types of pieces and legislation to help clients with many different scenarios. So if unsure, just give Andrew a call, and there's many different ways we can assist.
And just finally, Paul, 1 second, is that Roberto mentioned it earlier. People don't understand, if you let it get to liquidation, and if there's any ATO callbacks, then the director can become personally liable for the money the liquidator has clawed back for his own fees. Right, but it's so much better not to go into lick if you can avoid it.
Yeah, well said, and thank you. Absolutely invaluable sort of comments, thoughts, ideas, and hopefully it can help you guys that are online. So to all of you that have joined us, there's been a number of you that have joined us, so thank you very much. Hopefully it's been insightful. Team members that are listening to it, they can learn from it, and that's what this is about. So till I see you next time, I have a masterclass coming up on the 19th of September. It's all about sales techniques. So I know, given my coaching and training background as well, this is one that firms don't feel comfortable having those conversations. So we're going to take you through a whole heap of things. I've got a wonderful guest joining me. We're going to be talking about different sales techniques to help you to talk to your clients, and even having these sort of difficult conversations sometimes. A lot of firms don't know how to have that. So look out for that invitation. Till I see you next time, thanks for joining us, and enjoy the rest of your day. Thanks, Roberto. Thanks, Andrew.